Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from Consensus in Austin, Texas, and joining me for this segment, we have Sergey Nazarov, co-founder of Chainlink, which has transacted nearly $12 trillion since 2022. And we're here to discuss increasing interoperability and, of course, an important announcement just made by Chainlink. Sergey, it's great to see you as always. Welcome back to Trade Talks.
Great to be here. Thank you.
You got it. And let's talk about that announcement. DTCC and Chainlink this month, May, in case you're catching this on the rebound. You announced collaborations around smart NAV involving 10 financial institutions, JP Morgan, Franklin Templeton, and others. Tell us more about it and what's the significance of the announcement?
I think this is part of a trend towards fund tokenization because this put a critical piece of data on chain that is required to do fund administration. And what this shows is basically a very strong trend towards putting funds, mutual funds, all funds, which is a multi-$100 trillion industry, on chain. So what this was an incremental step towards putting critical data on chain, which is a key building block of putting the fund itself on chain. And this was also done in a way that works across chains, so that the data can function across different chains. And this means we're on a trajectory to put funds on chain in a way that'll function across multiple chains.
Right, and that's something that we've consistently spoken about, but stepping back a moment here, how will asset tokenization, how is that going to transform finance?
So asset tokenization and on-chain finance is really the new format for all financial products. Some financial products will emerge in that format, like carbon credits, as an example, and some financial products will be converted to that, like treasuries, money market funds, and existing funds. I feel there are really two forces pushing these assets into this format. One force is the immense efficiencies that are gained by generating assets on chain. The NAV work with DTCC proves that because the NAV data that we put on chain is accessed multiples, tens of times more efficiently on chain than it is off chain. And so the efficiencies of running these funds boils down to lower costs, easier administration, faster settlement of transactions. So things like atomic settlement become possible, where you can quickly transact in real time. And then the second big dynamic is consumer demand for assets. So both of these dynamics are now starting to increase, both the consumer demand for tokenized assets and the quality of the technology is leading to greater and greater efficiencies that are easier and easier to implement. And both of these trends are now starting to accelerate at the same time.
So how do you see the tokenization opportunity developing?
I think you have two categories of assets. You have core financial assets, like treasuries, money market funds, these types of things. And then you have assets at the edges, which are net new assets, tokenized carbon credits, tokenized real estate, tokenized private equity, things that you wouldn't historically be able to easily access in the traditional financial system, which you can access in the tokenized version of that asset. Which one of these is emerging quickest? I actually can't tell. I think they have different value. One of them is about turning traditional financial instruments into a tokenized form that token and smart contract systems can use. The other one is about giving new assets a chance to gain access to a larger customer base of people that have private keys, stable coins, want to buy new tokenized things. I would say right now, these two kind of opportunities are neck and neck. I can't tell which one is emerging as the dominant usage of real-world asset tokenization or digital assets. There's always the third trend of cryptocurrencies, Bitcoin adoption, ETH adoption, all of these things. That is something that I consider to be separate from digital assets and real-world assets. That's a purely kind of speculative activity around cryptocurrencies. But in digital assets, you have the core financial products and then you have net new assets. They're both kind of emerging at the same rate.
Well, Sergey, the question is, how can tokenized assets access liquidity in a fragmented blockchain ecosystem?
Yeah, that's a very complicated problem because the liquidity exists on many different chains. And all those chains are run by different banks, different asset managers that are putting their client accounts and the value of their user base on their respective chain. And so every big bank, eventually I think every asset manager will have value from their client base on their own chains. And then the connectivity between those chains is really what's needed. This is actually one of the key problems we work on in the Chainlink community namely through CCIP, the cross-chain interoperability protocol, which is like the TCP/IP of blockchains, connecting all these different bank chains and public chains into one internet of contracts. So the real solution to this is the same solution that you have in the web world, where you have a single standard like TCP/IP, connecting all the different internet technologies into a single internet. And that connectivity is really what forms the internet. And in the Internet of Contracts world, you need a single connectivity standard across all chains, both public and private, to emerge. And that's what CCIP, the cross-chain interoperability protocol, is seeking to do.
Yeah. How can banks and asset managers prepare for this shift toward blockchain-based markets?
So there's really two approaches. One is native integration, where you learn about every single chain. So you learn the details and the implementation of every single chain that you want to be on. But for banks, I think that's not realistic because they're going to have to be dealing with hundreds of different chains. The other way is you create what's known as an abstraction layer. So it's an interface that interacts with all chains and that your systems interface with. This is also what CCIP does. So this is one of the core ideas behind Chainlink. It's called Chainlink for a reason, because it can connect your existing system to all of these hundreds of different chains through one interface. And so either you choose to rebuild something like Chainlink in-house at a bank, which frankly is not what banks tend to do or like to do, because it's super costly and complex, or you use something like Chainlink, which is the leading way to abstract away blockchain complexity and connect data, identity, cross-chain connectivity against your existing systems. And this is where our work with great standards like Swift comes in, is making it easier to use your existing systems in relation to blockchains across hundreds of different chains. So that second approach is, for obvious reasons, the one that we advocate for.
Yeah, well, I mean, of course, it's so expensive organically, not even to, for the cost, but getting the skill set that's necessary to, match that kind of interoperability. To wrap up here, what are some of the key themes, or some of the takeaways that you're getting from Consensus this year?
The amount of capital markets attendance is extremely high. I would say it's at an all-time high. And also the seniority of the capital markets attendance, not just from speakers, but just attendees. So I would say that in 2024, we're at a point where the capital markets industry has passed the tipping point of deciding that blockchain technology, smart contracts, oracles, are the way that value will be issued, managed, and transacted in the financial system. People differ on how quickly that will happen, in what category of assets, in what category of technology that will happen. But I think we're now at a point where the most senior people, or even the people right directly beneath them that report to the most senior people, are actively working on blockchain implementation, smart contracts, issuing tokenized funds, issuing tokenized assets. And that's something that doesn't surprise me, because I've been working with the capital markets for over 7 years, and Swift and others in the capital markets have progressively, I think, always seen the value, but it's had to materialize in terms of a real market. And the size of the public crypto market at over $2.5 trillion, I think, proves that that value is there, and that's continuing to grow, so that's creating a bigger and bigger market there. And then also the technology is getting to a point of efficiency for implementing it and using it and actually having it deliver value to the bank or the asset manager, that large asset managers like BlackRock and others can actually launch a tokenized thing like BUIDL without huge costs. So as the technology cost gets lower, and as the market size gets larger, you will eventually reach a kind of inflection point for every asset manager, every bank, to be involved in the blockchain industry. And I think this is the year where that's really getting going.
It seems like the scale and the economics are starting to make sense.
Right, the economics from a market point of view, from a user-based point of view, from what you can make by making digital assets and making tokenized funds like BlackRock's BUIDL and others, and the cost of doing that is sufficiently low or going down rapidly enough in terms of running your own chain, using Oracle networks from Chainlink, connecting across chains with CCIP, so on and so on. So as the costs go down and the benefits go up, every firm has an inflection point, has a threshold at which it will say, it's worth it for me to now participate in the digital asset economy. And as long as the digital asset economy continues to grow, there's like a virtuous cycle that just keeps going until you reach the threshold of all the world's value being in this format. And we're very far from that. So we're at very small percentages of the global financial system in a blockchain format. So I think we are in the middle stages of public blockchains and the retail community there, and prop trading and hedge funds being involved in public blockchains. We're in like the mid stages of that industry's development. The global financial system migrating into blockchains, I would say we're in the very early stages of that. And that's very positive for our industry because it means there's a lot of continued growth to come over the next 1, 2, 3, 4, 5, and even, I would even say 10 years.
All right, Sergey, appreciate the insight as always. Thanks for joining us on Trade Talks. And
My
thanks
pleasure.
for joining
Thank
me
you.
from Consensus. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.